Something major is happening inside the U.S. job market, and it's not what the headlines or official reports are telling you. Month after month, we hear that unemployment is stable, that job growth is holding, and that the economy is resilient. But on the ground, millions of Americans are experiencing something very different. And once you see the full picture, you might understand why there's such a growing disconnect between what the data says and what everyday life feels like. By the end of November of 2025, companies had announced more than 1.1 million job cuts, far more than last year, and the highest yearly total since the pandemic. Yet somehow the unemployment rate remains near 4.4%. How is that possible? Because the official unemployment rate only measures people actively looking for work. It ignores the millions who have stopped searching, the people stuck in part-time roles they never wanted, and the growing number forced into taking second or third jobs just to stay afloat. When you factor in underemployment, the true stress level of the labor force becomes much clearer. At the same time, real wages have been struggling to keep up with living costs while companies tighten hiring plans and freeze growth. This slow squeeze, layoffs, rising wages stalling, and costs increasing is creating a pressure point that many households can feel, even if it's not reflected in the headlines. By the end of this breakdown, you'll understand exactly what's driving this shift in the U.S. job market, and why so many people feel the economy tightening even when the reports sound calm. On paper, the U.S. job market looks surprisingly stable. The official unemployment rate, known as U3, has hovered around 4.4%, far below levels seen in past recessions. Headlines celebrate monthly job gains, point to falling jobless claims, and repeat the narrative that the economy is holding steady. But these polished numbers often hide more than they reveal. And when you examine the pieces they leave out, you begin to understand why so many Americans say finding or keeping a job feels harder than ever. The first gap appears in the labor force participation rate, which sits around 62.4%. That means millions of working-age adults are simply not counted because they've stopped looking for work entirely. Some burned through their savings during long job searches. Others faced repeated rejections or age-filtering algorithms and quietly stepped out of the race. They don't show up in unemployment statistics, but their absence says everything about the true strength of the market. Then there's the underemployment issue. When you include people stuck in part-time jobs despite wanting full-time work, plus those marginally attached to the labor force, the broader U6 unemployment rate jumps to nearly 8%. This paints a very different picture. Not a healthy environment, but one where millions are technically employed yet still unable to earn enough to meet rising living costs. Even private payroll data is flashing warning signs. In November, the private sector unexpectedly lost 32,000 jobs according to ADP, an outcome that contradicts the narrative of steady growth. What all of this shows is simple. The official headline numbers don't represent the full reality. Underneath the surface, stress is building. And to see how deep that stress goes, you only need to look at who's actually losing jobs right now, and how fast those losses are piling up. If you want to understand why so many Americans feel uneasy about the future, you only need to follow one number: job cuts. By the end of November of 2020, 5 U.S. companies had already announced more than 1.17 million layoffs for the year. That's not a small uptick, that's a structural shift. It marks the highest annual total since the pandemic, and one of the largest waves of job cut announcements in 2 decades. And the industries leading the cuts are some of the most critical pillars of the economy. Technology, once the biggest engine of high-paying job creation, has dramatically reversed course. Companies that spent years expanding teams are now using 2025 to shrink them. Warehousing and transportation sectors that boomed during the surge in e-commerce are seeing thousands of roles disappear as demand softens and automation becomes cheaper. Retailers squeezed by uncertain consumer spending are trimming staff earlier and more aggressively than in typical pre-holiday cycles. Even legacy giants like Amazon, UPS, Verizon, Target, and GM have all executed deep reductions, each one signaling broader caution across corporate America. But here's the twist. Layoffs don't always occur because companies are failing. In many cases, businesses cut jobs precisely when profits are strong. Why? Because Wall Street rewards cost cutting. When UPS announced tens of thousands of cuts earlier this year, its stock price jumped double digits the same day. Investors interpreted the layoffs as a sign of discipline, even though thousands of workers paid the price. This cycle cost cuts leading to stock surges creates an incentive for companies to reduce headcount whenever they can. And with AI tools lowering staffing needs, many executives are choosing to downsize earlier rather than later. But what the public doesn't see is that the reported layoffs are only half the story. A quieter, more untracked form of job loss is happening behind the scenes. And that's where the picture gets even darker. The headlines only show a fraction of what's really happening. The big announcements, 10,000 jobs here, 20,000 there, create the illusion that layoffs are well documented and predictable. But beneath those public disclosures is a second, much larger layer of job losses that never makes it onto any official report. And for many workers, these invisible cuts are the ones hitting the hardest. One major blind spot is the world of contractors, gig workers, and temp staff. When these roles disappear, they rarely require WARN notices or public filings. A warehouse cuts 200 contractors, a retailer slashes holiday hours and never replaces seasonal hires. A tech company reduces a dozen outsourced teams overseas. None of this shows up in layoff statistics, yet the economic impact is immediate and severe for those involved. Then there are performance exits, a corporate term that has quietly become a layoff tool. Instead of announcing reductions, companies increase performance thresholds, impose unrealistic metrics, or restructure roles so they become nearly impossible to perform. Workers pushed out this way lose their jobs, but the company doesn't have to report a layoff. Holiday and seasonal employment, usually a safety net for millions of Americans, has also weakened dramatically. Retail job openings fell more than 22% compared to the previous year, the sharpest drop since the aftermath of the financial crisis. Some stores skipped seasonal hiring entirely, while others offered only minimal hours to existing staff. For many families who rely on holiday work to cover year-end expenses, this shift has turned a reliable opportunity into a dead end. When you combine these hidden reductions with the publicly announced cuts, the scale of workforce contraction becomes far larger than most people realize. And even for those who manage to keep their jobs, the battle isn't over because a new form of financial pressure is growing inside the labor market. And it's affecting workers in every income bracket. Even for workers who haven't lost their jobs, the financial pressure is intensifying. On paper, wages have risen modestly in recent years, but when adjusted for inflation, real earnings have barely moved, and in many cases, they've slipped backward. The cost of rent, insurance, groceries, and essential services has climbed faster than paychecks, leaving millions of households in a constant state of catch-up. Holding onto a job no longer guarantees stability. For many, it's simply not enough. This is where underemployment comes in. The broader measure of labor stress, known as U6, sits near 8%, almost double the official unemployment rate. This category includes workers who want full-time work but are stuck in part-time roles, as well as people who can only secure temporary or low-hour positions. In other words, they count as employed, but their income doesn't match the rising cost of living. It's a silent struggle that rarely appears in headlines, yet it affects millions. As wages lag behind inflation, more Americans are turning to second or even third jobs. Side gigs, weekend shifts, and overnight part-time roles have become common survival strategies. And employers know this. When companies realize workers are financially stretched, they gain leverage, making it easier to freeze wages, reduce hours, or offer lower starting salaries. In a tight economy, people feel they have no choice but to accept. Private payroll data reinforces this pressure. ADP reported a decline of 32,000 private sector jobs in November, highlighting a shift from slow growth to active contraction. With fewer full-time opportunities available, job seekers increasingly settle for whatever they can find. This dynamic, stagnant, real wages, rising costs, and shrinking full-time openings creates a labor market where stability feels out of reach. And corporations understand this dynamic better than anyone, which is exactly why so many have shifted towards strategies that prioritize efficiency over people. If the American workforce feels like it's losing ground, part of the explanation lies in how corporate incentives work today. Companies often insist they value their employees, but the financial system they operate in rewards something very different. The simplest way for corporations to boost short-term profitability and impress Wall Street is to cut labor costs. And that means reducing headcount. A clear example came earlier this year when UPS announced tens of thousands of job cuts. On the same day, its stock price jumped sharply, rising more than 10%. Investors didn't view the layoffs as a sign of weakness. They interpreted them as efficiency. Similar patterns appeared across Amazon, Verizon, GM, and other major employers. Cut workers, watch the stock rise. It's a playbook that has become almost predictable. Executive compensation structures reinforce this trend. Many CEOs receive bonuses tied directly to stock performance. That creates a built-in incentive to reduce costs aggressively, even when the company is already profitable. Cutting high-salary employees, freezing hiring, or converting roles into part-time or contract positions all help push margins higher, and shareholder approval often follows. Technology and AI accelerate this shift. Automation allows companies to reduce staffing levels without sacrificing output. Instead of hiring full-time employees, businesses can integrate AI tools, outsource specialized tasks, or restructure entire departments. Layoffs that might have taken years to justify now happen preemptively under the assumption that technology will fill the gaps. From the outside, these decisions look like simple cost-cutting. But for workers, they represent the steady erosion of job security. People aren't just competing with each other anymore. They're competing with algorithms, automation, and corporate efficiency models that reward doing more with less. And if younger workers are struggling to find meaningful roles today, the reality for new graduates entering the workforce may be even more challenging. For new graduates entering the U.S. job market, the path forward is more uncertain than it has been in decades. A college degree once acted as a reliable ticket to stable employment and upward mobility. But in the current environment, many graduates find themselves competing for a shrinking number of quality entry-level positions, and the mismatch between education and opportunity is becoming impossible to ignore. Across the Atlantic, the situation is even more dramatic. In the United Kingdom, more than 1.2 million recent graduates are competing for roughly 17,000 available jobs in their fields, a ratio so extreme it borders on unthinkable. While the United States hasn't reached that level of imbalance, the trend is unmistakably similar. Too many qualified applicants, too few career track roles. A major part of the problem is automation. Entry-level jobs, the very roles that traditionally give young workers their first real work experience, are increasingly being replaced or restructured by AI tools and automated systems. Tasks once handled by junior analysts, assistants, coordinators, and customer service representatives can now be managed by software, leaving companies less willing to hire new staff. On top of that, hiring freezes are particularly harsh on new graduates. When companies decide to slow or pause recruitment, they often eliminate entry-level openings first. It's easier to delay growth than to dismantle existing teams. The result? Thousands of graduates sending out applications for positions that simply don't exist. And even when opportunities do arise, intense competition drives starting salaries down. Graduates accept lower pay, fewer benefits, or temporary contracts just to get a foot in the door. But stepping into the workforce already behind makes long-term financial stability harder to achieve. But if entering the job market is tough for young workers, re-entering it after a job loss can be even more daunting for older workers navigating age bias and a rapidly shifting economy. While young workers face a shrinking pool of entry-level opportunities, older workers encounter a different, and in many ways, more severe set of challenges. For people over 40, especially those in their 50s and beyond, Losing a job in today's U.S. job market can feel like stepping off a cliff with no clear way back. The combination of age bias, automated hiring systems, and shifting skill demands creates a barrier far higher than most official statistics acknowledge. Modern recruiting software has quietly become a major obstacle. Many platforms automatically filter applicants using algorithms that flag gaps in employment, outdated job titles, or age-associated patterns in resumes. In some cases, lawsuits have already been filed, alleging that these systems disproportionately screen out workers over 40 before a human even reviews their application. This creates a silent bottleneck where older applicants aren't rejected, they're simply never seen. Financial pressure makes the situation even harder. A large portion of older workers lack adequate retirement savings, meaning they cannot afford to stop working even if they want to. When layoffs hit this age group, they face the dual challenge of needing employment urgently, but struggling to find employers willing to take them on. The result is longer job searches, lower reemployment rates, and in many cases forced early retirement without financial readiness. Long-term unemployment data reinforces this divide. Workers over 50 consistently experience longer stretches of joblessness compared to younger groups, and when they do find work, it often comes with lower wages or reduced hours. Stability becomes harder to rebuild, and all of this is unfolding at a time when living costs continue to rise, putting additional strain on households already navigating tight budgets. But this widening gap across ages, industries, and income levels ultimately ties back to one overarching force reshaping daily life: inflation and the broader economic slowdown. As layoffs rise, wages stagnate, and full-time opportunities shrink, households are being hit by a second major force: the steady climb of living costs during a prolonged economic slowdown. Even with inflation cooling from its peaks, prices remain far higher than they were just a few years ago. Rent, insurance, utilities, healthcare, groceries, nearly every essential category has grown more expensive. And unlike temporary spikes, these increases don't unwind. Once prices move up, they tend to stay up. This creates an ongoing squeeze. Workers whose paychecks have barely grown in real terms now face recurring expenses that climb faster than their income. Many families are being forced to adjust spending habits, cut discretionary purchases, delay travel, and reduce savings contributions. Even small unexpected expenses, a car repair, a medical bill, can cause financial strain in a way that feels unfamiliar compared to just a decade ago. Businesses are responding to this environment with caution. Retailers are bracing for weaker holiday sales. Companies in transportation, warehousing, and logistics are reporting softer demand. Restaurants and hospitality sectors add jobs, but mostly part-time roles with lower wages. Rather than a vibrant labor market, what's emerging is a landscape defined by scarcity and caution. Consumer confidence reflects this reality. Surveys show that Americans feel less optimistic about their financial future, even when employment numbers appear stable on the surface. They're not just reacting emotionally, they're responding to a pattern: higher costs, fewer opportunities, and more risk in every financial decision. All these factors together signal a deeper structural shift. The economy isn't collapsing, but it's tightening. Growth is slower, opportunities narrower, and stability harder to achieve. The U.S. job market is no longer defined by abundance. It's defined by pressure. And with this context, we can look at the bigger picture: what this slowdown means for workers today, and what it could mean for the years ahead. When you step back and look at the full picture, the story becomes clear. The U.S. job market is shifting in ways that official reports often fail to capture. Layoff announcements have surpassed 1.1 million this year. Underemployment continues to rise, and the cost of living remains dramatically higher than before. At the same time, companies are tightening hiring, leaning on automation, and prioritizing efficiency over expansion. This combination has created an economic slowdown that workers feel long before it appears in the data. For many Americans, stability has become harder to secure, and navigating the workforce now requires more awareness, flexibility, and preparation than ever before. Which part of this breakdown surprised you the most? If this analysis helped you understand what's really happening beneath the surface, make sure to subscribe so you don't miss the next deep dive into the forces shaping your financial future. RT of this breakdown surprised you the most. If this analysis helped you understand what's really happening beneath the surface, make sure to subscribe so you don't miss the next deep dive into the forces shaping your financial future.